Forex Focus brought to you by IG, a real fun story here developing as central bankers meet and we get ready for a very important inflation number. And I thought, what better time than now to bring on our friend Paul Cappetta from IG, who knows so much about how central bank speak can affect different Forex markets and also hopefully lead us into this very important inflationary measure that's about to come out and will, of course, influence the U.S.'s decision on interest rates in the latter part of July. Paul, how are you doing, my friend?
Good. How are you, Frank?
Fantastic, man. Glad to have you back here on the program. Paul is quickly becoming one of the network's favorite personalities here, specializing in Forex interest rates and more macro stuff, how the central bank can affect all these different markets. And so let's get right into it, because some very interesting and tasty sound bites coming from the meetings that central bankers had over in, I believe it was Portugal and Spain, and especially out of our Fed Chair Powell. It seems like he almost won. It wasn't a competition, but our U.S. dollar came out stronger. And so I thought we would dissect some of his thoughts and also kind of help people with A to B to C what this type of sentiment translates to in hawkish versus dovish and how that translates to interest rate and Forex markets and then stocks as well. And maybe you can give us a little bit of context here. We're looking at the U.S. dollar versus the yen, Paul, and obviously doing quite well the last couple of months, but also the last couple of days, putting in some new highs in tandem with what Fed Chair Powell spoke at the forum here. Maybe you can help viewers to decipher. He says something like this. What does that mean in terms of the binary of hawkish versus dovish, and how do those, two parts of the decision tree, so to speak, kick out into potential interest rate activity in the future, and then the U.S. dollar? Because Powell said he wouldn't take moving consecutive meetings off the table, obviously speaking to moving higher in interest rates. So yeah, how does that pan out in terms of that hawk versus dove, and then interest rates and Forex and beyond?
Yeah, sure. So when I think about the hawk versus dove and kind of this case, I'm thinking about what he's told us previously and where he's forecasting Fed funds rates to go in the future. The Fed funds futures rate market hasn't even priced in the second hike yet this year, so I'm still waiting for that to get fully priced in. But yeah, he sounded like a hawk yesterday. Basically, more rate hikes are on the table. 2 consecutive meetings is possible. He also mentioned that he didn't think that monetary policy was sufficiently restrictive for long yet, which means we're just getting there. So that's what I got. I basically don't see any. He didn't really mention any thoughts of a pivot, no potential for rate decreases. So that's what I got out of him. He seemed more like a hawk yesterday. It's really hard to tell because he always tends to walk back some comments. I believe our June rate hike was a hawkish pause, which is always interesting. Yeah. You could even get something like a dovish hike, which seems usually really contradictory. Usually
pretty even keeled.
Yes.
But this week he seemed like almost so more direct than he's been in the past, speaking to not worried about how the market takes what the FOMC does in future meetings. And I know it might be simple, for guys like you and me who've been around these Forex markets and interest rate markets and everything. But how does him coming off as a hawk translate to USD bullishness or bearishness necessarily?
Yeah, sure. So if he comes off as a hawk, that means we're higher interest rates for longer. So that's going to generally tend to lead to the dollar increasing in value. So you see something like dollar yen has increases like it has. There's a little bit more dynamics in play, and the BOJ was there at the meeting as well.
And they were on the flip side of this, right?
Yes, correct. Yeah, I mean, what you get out of the BOJ is never much. They're very kind of cryptic in their answers. It was interesting to see them talk there. And I believe we're going to talk about Japan in a little bit, but it was definitely an interesting conference. As far as they all basically were saying they're data dependent, and we know inflation data is lagging. So it was an interesting talk.
Yeah, and speaking directly to, so not only we've got the hawkish feel, like you said, haven't gotten restrictive enough and not really caring what the stock market has to say about it is a pretty important note, because I think a lot of people who are pricing in the interest rate cuts at the later part of this year or in 2024 were the types that were like, oh, the Fed is just hiking just a cut. They want to hike it up. Stock market falls a little bit. And then when the stock market starts to really gain some steam, then they're going to cut everything down just to lift that stock market up. He said explicitly they are worried about inflation. And another thing that he said that maybe puts people off, which is the idea that inflation, in his view, is probably not getting down to their 2% target for the next probably full year to 2 years. And here we have the core inflation that's been so sticky, got up to heights of 6.6% and has come down lower, which if you've got that fear at home of inflation being out of hand, at least we have this hawkish Fed who's, like I say, is dead set on getting this lower. But this is what they're worried about, Paul. This is the reason for the hawkish intonation. And we have an upcoming meeting where we'll see how the U.S. moves interest rates from where they're currently at 5.25 atop the major economic board of interest rates here. And maybe now you can speak a little bit to the BOJ and their dovish past and dovish statement here, where they're saying, we're stuck a little bit. We're not at 2% inflation, and we have no reason really to hike interest rates, and how that's reflected in their currency. Maybe you can speak a little bit to that dovish part of it, and why they feel stuck. Where do they feel stuck here?
Yeah, so they've been stuck for a long time. This isn't like something new. This is something new to developing this year. Basically, growth in Japan hasn't really been good since the 90s. Their stock market, the Nikkei, which is actually one of the best performing stock markets this year and all around the world, in yen terms, of course. But their growth has been flat. So you have basically inflation with flat growth, which, if I remember from my college days, I believe is stagflation, but I might be wrong on that one. But it's not necessarily an easy thing to fix, because you can't necessarily have restrictive monetary policy with very low growth in the economy. So that weighs on the yen, and you see things like euro yen and pound yen at multi-decade highs, and then dollar yen getting back to where we were in the fall. And then there's always the hint that the Ministry of Finance in Japan will curb some of that yen weakness with some intervention, but you never know what level. I've heard levels of the 150 level in dollar yen, but we'll see. That'll be something to keep an eye on over the next couple of weeks.
Yeah, definitely. This graphic, I think, shows you all you need to know about why you're seeing decade-long extremes in the forex market between U.S. dollar over yen, British pound over yen, and euro over yen as well, because obviously those forex traders looking for not only that stronger economy, Paul, but the higher interest rate to be long versus financing that currency that they're buying at a lower interest rate, at a negative interest rate there in Japan still. But let's get into tomorrow's PCE number. Core PCE is what we're going to get. It's been sticky at about 4.7%. They're expecting at 4.7% tomorrow morning. And Paul, the Fed has said that this is one of their preferred inflationary measures. Maybe you can speak to, if we get a number in the 5 handle, what that means for the Fed at future meetings and the U.S. dollar beyond that, and also, what that could mean for the stock market, given that last year you can't not talk about the correlation between interest rates going from 0% to 5% and the stock market being off, 20 to 30%, depending on where you were looking, versus a number in the lower 4s here in inflation. How do you think the Fed might digest tomorrow's PCE one way or the other?
Yeah, so if we get a lower PCE, lower than 4.7, because we've been pretty much flat, just based on your chart there. Mm-hmm. If we get a lower number, you might see a less hawkish Fed. based on what Powell was telling us yesterday, I'm not sure if we're going to get a lower number. We might stay on this path continued. But we'll see. I mean, the PCE is different. It's much different than the CPI and what it looks at. The methodology is totally different. I was actually looking at this last night because I know the numbers are different, but just why are they different? And the main difference, so CPI is really urban inflation.
Okay.
And PCE is urban and rural inflation, but the weightings are different. So PCE tends to look at things like healthcare services and financial services more closely than the CPI does. And the CPI is more heavily weighted towards your shelter costs, so things like your rent or the cost of a house, and the energy costs. Obviously, we know oil's been down almost in half since where it was last year at its highs. So that affects CPI more than it does PCE per se. So the numbers are different. The methodology is different. There is chances, and this happened in the past, happened last fall, where the PCE diverges away from the CPI as far as what they're moving. So it will be interesting to see what we get tomorrow morning. Based on this chart, you may see just another flat 4.7.
Yeah, I mean, great notes there, and we'll conclude with this, PCE expectation and what it could mean. Higher inflation might mean higher interest rates, might mean a more bullish U.S. dollar, and to the flip side, you could expect that if the number comes in lower than expected, the Fed Chair Powell doesn't have to be as hawkish as he's been talking about, doesn't have to hike interest rates as much. Maybe U.S. dollar comes off a little bit. But great points there. The CPI essentially being kind of a more volatile piece there, or if you're used to looking at volatility of the stock market or whatever, maybe a more short-term kind of look of, like crude oil is higher and so energy prices are ripping and so CPI is ripping real high, whereas PCE is maybe a more well-rounded look at things, and that's why the Fed likes looking at it more as they don't have to freak out over a higher than normal CPI number, and then 3 months later it's lower than normal. So it'll be a really interesting reading. You have to imagine that Fed Chair Powell has a lot more data than we have, and so if he's expecting inflation to stick around, then maybe we'll see this 4.7 or higher, but only time will tell.